Friday, December 11th, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at commodities, again, general commodities, not just the monetary commodities that we look at very closely, of course, like gold and silver, but all the other ones. And we're going to look at the CRB Index. The CRB Index is looking very interesting as per the technical picture. We've broken through some key technical levels. I'm going to compare the CRB Index to the dollar index, to gold, and go back to around the turn of the century when we had a major bull market in commodities, a move lower in the dollar and a move higher in precious metals, of course. And usually gold leads the way, and it has been also this time around, I would say. Before that, let's quickly look at where the markets are this morning. It's 8:30 a.m. We've got spot gold at 1832.50. Yes, it's down 4. The high has been 1847, low 1831.50. Silver is down 14 cents, just over 0.5% at 23.84. High has been 24.08, low 23.78. Dow future down 120, just below 30,000 at 29,880. S&P 500 is down 18 or 0.5%. NASDAQ 100 future is down almost 2/3%. Currencies, we got the pound down 0.5% at 132.20. Looks like we're going to have a no-deal Brexit. They're going to blame a lot of things on the back of that, of course, and the disease that we're witnessing this year. But don't be fooled. The mayhem we're seeing in the markets is the culmination of 50 years of fiat currency ever since Nixon took the dollar, the gold anchor off the US dollar, of course. Euro is down slightly, about 0.1%, 121.25. As per the euro, yesterday we saw Lagarde and the ECB announced another $500 billion of QE. What's 500 billion these days? Not much. The dollar is down slightly versus the yen at 104.11. WTI crude is up 0.5% at 47.11. Copper is down 1.3% at 352.73. The 10-year yields to finish off the markets is at 0.91. So we've drifted back lower a little bit from the beginning of the week. We're around 0.94. So bond markets have recovered a little bit. So now let's look at the commodity sector, CRB index, the dollar index, and gold. And what you have to realize, of course, over just about 2/3, I would say, of foreign reserves around the world are held in US dollars. So what higher commodity prices or bull market in commodities signify is less demand for dollars. Back in the period from around 2002 to 2008, the demand for dollars dropped. Commodities went up. We had the real estate bubble. We had the, economies did quite well. And we had this moderation, as they call it. Inflation was under control. Prices were still not too elevated, and it looked like it was more on the back of economic growth. China coming online, other emerging market countries. But lower dollar and higher commodity prices can also mean, in the Austrian view of things, demand for dollar dropping. And usually that makes the value of the dollar less, of course, if you demand less money. And that's what the dollar is for the world economy. That money will become worth less and less, and you could get higher prices, especially in this uncertain period that we're in, where economies are really not doing very well. We've had the worst recession or depression, really, if you want to call it, in the UK for 300 years. We had a huge drop in economic activity all through the West. Yes, it was because of the lockdowns, but don't forget, prior to that, we were already entering recessions in countries like Germany. Even the UK had negative GDP growth late in 2019. Even China had the weakest growth in 30 years. So what is it going to be this time? What's the theme going to be for this next bull market? And how long could it last? I personally think it could last another 4 to 5 years. And I think people ask, so what inning are we on? I think that commodities are just getting on to the game. They've been changing the locker room. They've been warming up a little bit on the field, and they're just starting the top of the first inning. So it's very early days. So CRB Index is a really important index in commodities. It's been around for ages. Well, since 1957, or to be exact. It appeared for the first time in 1958. It was calculated by the Commodity Research Bureau, and it includes the following 19 commodities. And that's why it's important to look at the CRB, because if they're all moving higher, these commodities, it means that it's confirming the weaker dollar. And don't be fooled again to think that you're going to be okay hedging yourself with the euro or the British pound or the Swedish krona, Aussie dollar, Canadian dollars. The best hedge will be commodities themselves. Yes, it's hard to have some of these things at home, but as I've said many times, gold and silver will do very well too. So there are 19 commodities in the CRB. Aluminium or aluminum, depending where you are and how you pronounce it. Cocoa, coffee, copper, corn, cotton, crude oil, gold, heating oil, lean hogs, live cattle, natural gas, nickel, orange juice, silver, soybeans, sugar, unleaded gas, and wheat. So that's the CRB index. And before we look at the charts, I've talked about this several times. This is from In Gold We Trust report from earlier this year. And they were talking, of course, how the commodities are so undervalued versus stocks, that it hasn't been this undervalued since recorded market data, really, and since 1900. I guess the only period comparable to where we're now was back in the 60s, and we know what happened in the 70s, right, to commodities, the economy. So I think we're going to get the same kind of environment. It's not going to be as comfortable for the general public, especially in the West, as in the early 2000s, where we had the housing boom. We had the economy's doing quite well up until '08, of course. I think it's going to be more like the 70s, stagflationary, even hyper stagflationary maybe. I made that comment yesterday in the tweet. We could get very high inflation as they measure it. Well, they might not really show it in the data, but we will feel it in the shops and everywhere else. We are already feeling it. Can you imagine when commodities start moving higher, which I think they are ready to do very soon. So you can see there that even in 2000, when commodities and precious metals bottomed and then had their bull market up until 2008, commodities weren't as undervalued as they're now. So if you think cost of living, groceries, rent, and everything else is going up now, you ain't seen nothing yet, as the saying goes. So now let's look at the charts. And well, let's start with the CRB index. So you can see here, back in the late 90s, the CRB index looked like it was gonna breakout a couple of times back in 97, 98. And it seems to be the 200 level that's important. But we made a double top there in 2001. We made a top there and then it came down. And people must have been thinking then, oh, this is it. I'm not going to get into commodities. Commodities are, how can I say, useless. And the Keynesian fallacy as well doesn't help. And I think it's not going to help, especially this time around. They think that a weak economy can't translate into higher commodities because they don't look at it the Austrian school way, the Mises way, that says that less demand for money means that that money will become worth less. And you could have that happen even in a recession. So commodities don't only go up because the economy is doing well, but they can go up also during a period of economic stagnation. You might want to call that deflation. Yeah, whatever. But you can see here that it started picking up again towards the end of 2002, and it broke through that 200 level, let's see, in February of 2003. And then it came back down, retested the 200 level. That's the famous retesting of the breakout, which is very bullish in technical analysis. And we did that. And again, people must have been thinking back in April of 2003, when we went back below 200, well, you know, gold is not going to go anywhere. Commodities are not going anywhere. But then from then on, as you can see, it just went up almost in a straight line. Yeah, there was a correction in 2006. But then we topped almost at 500, and that was just right during the 08 crisis, of course. And ever since then, it's been in a bear market, all the general commodities. And gold, of course, has kind of led the way. We made a low, as you can see, towards the beginning of 2016. The low in gold, of course, at 1,045 was in December of 2015. So gold was ahead in the cycle. And we kind of done the same thing here. If you look at the late 90s, we've retested that 200 level one time, not twice. We've even gone back to break back below the 2016 low there. And now we're coming back, and we've actually just broken back above that 2016 low. I would say it's very significant, this breakout. Yes, it could go back down to retest that level, which is around 155, but I think it's looking very good. Right now we're at 161.39. And this is a monthly chart, of course. So let's just show you a shorter term chart here. Again, 200 is going to be the key level there. I'm not saying we're going to get there today or tomorrow or next week, but it could be fairly soon, maybe in the beginning of next year. So with that, let's have a look at gold, because gold here, as you see by this chart, really, the bottom was in 1999. Back in 2001, we kind of retested that bottom. But yeah, the bottom was like, let's say 2001 at around 250. By the end of 2002, gold was back to like 350. The CRB was still doing its thing. It still hadn't broken back above 200. It broke above 200 beginning of 03, came back, and by that time gold was on its way to 400. So that's what happened there. And in 2008, gold as well topped at 1,030. And the amazing thing here is that gold has kept going. And why is that? Well, I think it's because it's a monetary metal as well. So gold has outperformed commodities. with commodities being in a bear market, which is quite amazing, I think, and which will make, I think, this bull market in gold even stronger now that commodities are going to join it, the other commodities there, that is. And now the dollar index, because I said in the beginning of the video, my premise is that lower commodities are a reflection of a lower demand for the dollar. I interviewed Rafi Farber, I think it was 3 weeks ago or so, and he writes his blog in Seeking Alpha and Time Investor, and he was noting how countries like Egypt and China are stockpiling wheat or commodities. We saw recently, about a week ago, that Uzbekistan, which isn't really the most important country, but it's a very wealthy country in terms of resources. Their central bank, their government is now pushing their population, I think it's about 35 million people there, to use gold as another currency, to save in gold, and to maybe even start using gold to transact. So there are signs there that countries are starting to do that. The dollar going down is not just a matter of Americans' demand for dollar going down as well. And by demand, I mean demand for money. What it means is that people don't want to hold cash. They want to get rid of it for real things. I think the world is even more important internationally because foreigners hold a lot of dollars. So if they start getting rid of it, that means that they want something real, so commodities. So let's go look at the longer term chart here for the dollar index. You can see that the dollar index topped in July 2001, then it went down, and then it went back up in January of 2002. So it made like a double top there. And this was just around the time that gold and commodities, the CRB index, were bottoming. And you can see that after that, the top just above 120, it went basically in a straight line down to 70.69 back in March of 2008. And if you look at the dollar index now, we made a top in January of 2017, and we made a top in, where was it, March of this year. I know it's about 3 years apart, but it looks very similar to what happened back in the beginning of the century with that almost triple top, really, because we also topped in the beginning of, in October 2000. And it's been right around this time here from 2017 and even a little before that, that commodities and gold have bottomed as well. So I think this is confirming with commodities that the dollar did top in January of 2017. And I've done videos about the cycles in the dollar index, and they take anywhere from 7 to 9 years, be that an upward leg or a downward leg. And I think taking the top in 2017, it could be a leg down all the way to 2024, even 2025, maybe even a little longer. And that's why I think, and I said in the beginning of my video, that I think we could see this commodity bull market, dollar bear market, go on for another 4 or 5 years, maybe even a little longer. I think the bottom is going to be lower than it was back in 2008, because as you can see here, we're making lower highs and lower lows. We made a high of around 165 back in the mid 80s. We made a low just below 80 in the early 90s. And then we made a high at 120 in the late 90s, early 2000s. And then we made a low at 70.69 in 2008. So I think we're going to go lower in the dollar sometime in the middle of this decade. So there you go. I will keep you updated on the commodities market, on gold and silver, of course, and the dollar. I did make a video on commodities on the 25th of November about how it's signifying a weaker dollar. I'll put it up in the cards as well. And you can look at that video if you haven't seen it yet. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great day. Take care. Bye.